Everyone around you right now is celebrating. Stock market is up. The Dow had its best week since November. The Nasdaq jumped nearly 5% in 7 days. Social media is full of people buying the rally. But right now, while everyone else is celebrating, smart money is doing something completely different. You need to know exactly what that is. Let me tell you what is actually happening beneath the surface of this market. The ceasefire rally was real. The gains were real. But the underlying problems that caused the crash in the first place have not been solved, not even close. The investors who understand that simple truth are positioning their money in a completely different direction than the crowd right now. Charles Schwab said it plainly in their latest market analysis. The ceasefire rally looks to be driven more by rapid unwinding of hedges and speculative positions than by any fundamental resolution of the conflict. In plain English, traders who bet on disaster simply covered their positions fast. That is not the same thing as the world actually becoming safer or the economy actually getting better for ordinary people. Here's the clearest proof that smart money never fully believed this rally. Even on the biggest day of ceasefire celebration, when the Dow surged over 1,300 points, gold prices stayed elevated. Treasury bond demand stayed high. Real institutional money was buying stocks with one hand and buying protection with the other simultaneously. That is not genuine confidence. That is professional hedging against the next coming disaster. JP Morgan's global market strategist put this situation into perfect perspective. He pointed out that in just 14 months, markets navigated Liberation Day tariffs, the longest government shutdown in U.S. history, 100% tariffs on China, bombing Iran, regime change in Venezuela, and a Japanese bond market crisis. Every single time markets jolted sharply down and then fully recovered. Investors who panicked and sold at the bottom lost money every single time. Here's the critical lesson. Smart money learned from all those repeated shocks. They stopped reacting emotionally to scary headlines. They started positioning strategically before the next shock arrives. Because by the time a shock hits the news, it is already too late to protect yourself cheaply. The investors making real money in 2026 are the ones who prepared before the headlines, not the ones desperately chasing rallies afterward. So what is smart money actually doing right now? First, they are keeping their energy positions intact. Oil prices are still sitting near $94 per barrel, still 30% above pre-war levels. Goldman Sachs warned clearly that if the Strait of Hormuz remains restricted, Brent crude could average over $100 for the full year. ExxonMobil and Chevron are both still up 26% for the year. Smart money is not abandoning that profitable trade just because markets rallied for one single week. Second, smart money is watching the oil futures curve carefully instead of listening to emotional headlines. The May 2026 oil contract is still near $96, the June contract near $88. Even December 2026 oil futures are still 15% above pre-war levels. The futures market, where serious professional money trades daily, is telling you energy prices are staying elevated for months ahead. The futures market does not lie the way feel-good headlines sometimes do. Third, smart money is buying quality dividend-paying energy companies rather than speculative growth stocks. ExxonMobil recently raised its dividend 4% while beating earnings estimates. Chevron did exactly the same. These companies generate enormous free cash flow whether oil trades at $70 or $120 per barrel. They pay you real income while you wait patiently. That is a completely different strategy from blindly chasing momentum stocks on a temporary ceasefire rally hoping for the best. Here is something mainstream media is barely discussing. The U.S. and Iran peace talks in Pakistan completely collapsed over the weekend. The U.S. announced a full blockade of the Strait of Hormuz after negotiations fell apart. Oil prices immediately surged back above $100 per barrel on Sunday night. West Texas Intermediate jumped nearly 8% in a single evening. The entire ceasefire rally evaporated within hours, exactly as smart money had quietly prepared for all along. UBS released historical analysis showing that when the S&P 500 drops 5 to 10%, within 3 to 4 weeks of a geopolitical shock, it is typically back above its pre-conflict levels 6 months later. That is good long-term news. But UBS also warned investors specifically against complacency because any serious escalation between the U.S. and Iran is not remotely priced into current stock market levels right now. BlackRock, the world's largest asset manager, controlling over $10 trillion, raised its outlook for U.S. equities. But they did it carefully. They said a contained macro impact from the war combined with solid corporate earnings could create conditions for future gains. Notice what they did not say. They did not say the war is over. They did not say oil goes back to $70. Smart money always reads carefully between the lines of what major institutions say publicly. The housing market is also flashing warning signals most retail investors are completely ignoring. Existing home sales hit a 9-month low in March. Sales fell 3.6% in a single month. Mortgage rates climbed to 6.64% at their conflict peak. Even with the ceasefire dip, Rates are still near 6.4% today. The average American family trying to buy a home is still being crushed by costs that trace directly back to this still unresolved conflict. Here is exactly what smart money is doing differently from the celebrating crowd right now. They are trimming positions in stocks that surged purely on ceasefire emotion, with no fundamental reason to hold those gains. They are rotating into quality energy companies with strong dividends and resilient cash flows. They are maintaining gold as a permanent portfolio hedge, and they are keeping cash reserves ready to deploy aggressively when the next shock creates the next real buying opportunity at lower prices. Here is the absolute final bottom line. Everyone buying this rally is betting that a fragile 2-week truce between two countries with zero trust will permanently solve one of the most complex conflicts in modern history. Smart money is simply not making that naive bet. Stay diversified. Stay hedged. Watch the oil futures, not the emotional stock market headlines. Stop following the celebrating crowd. Start following the cold, hard data instead. That is the difference between the investors who win and the investors who always wonder what went wrong.